Okay, am I on? Yes, I'm on. I haven't quite got the luxury of being as tall as the last presenter, so I might have to stand just about here, otherwise I'll disappear. Good evening, everyone. My name's Dorian. I'm the Chief Executive of the Belvoir Group. I'm here with Louise, my trusty CFO. I've been with Belvoir for the last 14 full years. Louise has been with the business for the last 5 and has deep experience on AIM. During my sort of period with Belvoir, I spent 5 years on a voluntary basis as a director of the Property Ombudsman, dealing with sort of consumer redress, and a few sort of notes before I launch into the presentation itself. First of all, in the little booklet that will be available afterwards, our results came out a week ago, so we're at the end of a sort of 2-week-long investor roadshow. Our H1 results and presentation are in the back of the little booklet that you can collect afterwards. We also changed broker from Cantor Fitzgerald. It's the first time we changed our broker in 6 years. We changed to FinCap a few weeks ago, and the point to be mentioning this is that FinCap make their research available to everybody free of charge, whereas Cantor Fitzgerald used to make it only available to people who wanted to pay for it. So if you do want to see a copy of FinCap's note, which includes our projections going forward, please let one of us know and we'll arrange for the note to be sent to you. Before I sort of move on to the business itself, just a few sort of key points about the business. We've had, up until the end of 2018, we've had 22 years of unbroken profit and turnover growth. We're a profitable business. We return profits to shareholders by means of dividends. Our current dividend yield is just over 6%, and since we came out with our results a week ago, the share price is lifted by 10%-ish, thereabouts. So a good set of H1 results. We're very confident about H2, and we've already committed to a progressive dividend policy. So even though our dividend yield is over 6% at the moment, we have committed to increasing the dividend in H2. So, who are we, first of all? Well, normally whenever I sort of mention the name Belvoir Group, somebody says, well, how do you pronounce that? Is it Belvoir or Beaver? And one of the other speakers said to me as soon as I walked in, is it Belvoir or is it Beaver? So if you're in the sort of East Midlands area, which is where we started, that's where we're based, that's where we live, people tend to call the brand Beaver, but everywhere else, generally it's Belvoir. So we are a franchise network, so a property franchise network, not to be confused with corporate estate agency chains. So we're a property business. We operate under 3 key brands. So the first brand being Belvoir. We listed 6 years ago on AIM. Our list price at the time was 75p, and we've grown gradually since that point. We've always paid a dividend. We've never missed a sort of beat on our dividend to shareholders. And this is only the 3rd retail event, sort of private client, event that we've done. We've got a very strong, most of our shareholders are institutions, income funds, sort of investors looking for that sort of, the yield type stock. So very steady growth over the period. Belvoir was the main brand. We listed as Belvoir 6 years ago, and we now have 174 Belvoir offices. We then grew partially by acquisition. So in 2015, we bought a business called Newton Fallowell. I appreciate you won't see any Newton Fallowell boards in Edinburgh, and that's because it's an East Midlands estate agency chain. And then in 2016, we bought the largest independent property franchise chain called Northwood. The difference between the 3 brands, so Belvoir is primarily an agency chain specialising in residential letting, so we manage properties for landlords, and the revenue split of franchisees' income within Belvoir is 90% from residential lettings, 10% from estate agency. Newton Fallowell is the other way around, so a very strong regional estate agency group, 75% of their revenue from estate agency, 25% from residential lettings, and Northwood, very similar to Belvoir, 90% residential lettings, 10% estate agency. The reason I wanted to say that is that underpinning our income, so we as a franchisor, our franchisees pay us a percentage of their revenue, and we call that management service fee. Other people call that royalties, but any franchisee within a franchise model pays royalties to the franchisor in return for a number of things. And typically that's website, compliance, training, business support, technical support, marketing. We provide a suite of products for our franchisees, and in return they pay us a percentage of their turnover. The reason why it's a percentage and not a fixed fee is that a good franchisor will be completely aligned with their franchisees and motivated to help them grow turnover. Therefore, it's a percentage of their turnover rather than a fixed fee. Now, so we've worked very hard over the last few years to grow our footprint to a national footprint. We've got 300 offices now across the UK. We decided to introduce mortgage services to our franchisees, and some of you may follow another AIM-listed business called Mortgage Advice Bureau, which I'll shorten to MAB as it's easier, or MAB. We first bought a mortgage business in 2017, a very small group of mortgage advisors based in Barnsley, profitable, and really as a management team we wanted to cut our teeth on the mortgage side of the business. If you're familiar with Mortgage Advice Bureau, it's a successful AIM-listed business, market cap of around 300 million. It's an umbrella network, very similar to a franchise network, whereby individual mortgage advisors trade as Mortgage Advice Bureau in return for, again, access to systems, access to lenders, whole of market mortgage advice, and the mortgage advisor is sort of free to go out and generate business under the MAB umbrella. So the first mortgage business we bought was an MAB key account. We brought on about 35 mortgage advisors 2.5 years ago. We then acquired MAB's largest key account at the end of last year, meaning that we finished last year with 123 mortgage advisors. We've grown organically to 136 mortgage advisors in H1, and we're looking to increase that to 150 by the end of this year. So in terms of a comparison to Mortgage Advice Bureau, Mortgage Advice Bureau has around 1,200 mortgage advisors. As a business, we now represent 10% of Mortgage Advice Bureau's advisor base. And it's very simple what we're looking to do with this. We're just looking to roll out mortgage advice across our 300 offices and allow our franchisees, our property-based franchisees, to build a business within a business by means of mortgages. Okay, so the markets that we operate in. Our DNA, we're primarily a residential letting specialist, so that's how we're listed. We've since the listing, we've branched out into estate agency and into mortgages. There are 4.5 million households in the private rented sector, 13 million people renting. It's a huge sector. 50% of all landlords who own a property that they let out use a letting agent. So half of the industry, half of all landlords do not use an agent for anything. Government is really driving sort of change in the private rented sector. Regulation is increasing. It's becoming much harder for private landlords to operate. Therefore, the services of a truly professional letting agent are becoming more necessary. In terms of size, we manage 64,500 residential properties across the UK, and we're now the second largest lettings business in the UK, second to Countrywide. So Countrywide, huge corporate chain. Main difference between our business and Countrywide, Foxtons, LSL, the other corporate chains, is that we have a franchisee at the heart of each business with 100% skin in the game. Franchisees work incredibly hard to grow every year, and we provide the tools with which they grow. 3% share of target market, so we class the target market as being landlords who do use a letting agent. And our lettings to sales ratio across all 300 branches is broadly 80-20. And again, the point of that number being in the presentation is that we're underpinned by a strong revenue stream called management service fee, the percentage of turnover paid by a franchisee to the franchisor. The franchisees are underpinned by revenue that's derived from recurring revenue. It's letting agents charge fees to landlords for collecting rents. Even if a franchisee closes their door or has a bad month in terms of new business, tenants continue to pay the rent and we still continue to receive our management service fee. So we're underpinned by an annuity style revenue. On the sales side of the business, we're relatively new to estate agency. We started offering property sales a few years ago. Contrary to what the market's doing, so broadly the property sales market is flat. UK transaction numbers have been falling back by about 2% a year for the last 2 years. Belvoir franchisees and Northwood franchisees grew their revenue from estate agency by 17% in H1. Newton Fallowell, which is already a good estate agency group, is also growing their revenue too from estate agency. So franchisees are just taking business from the larger chains. House price inflation, which doesn't particularly impact on our business, but house price inflation 0.9% UK-wide. Appreciate that. You know, it's been much higher in Scotland in the recent years. So I mentioned the 7% increase on property sales. Online agents, you know, it's a question that investors often ask me. Are online agents taking market share? You know, Purple Bricks, Yopper, eMove and such like. And these businesses have sunk, I'm not sure, it's not quite £1 billion into marketing, but it's getting very close. They've certainly sunk hundreds of millions of pounds in. And after making a huge investment into estate agency, online agents have managed to take 7% of UK transactions, which isn't insignificant, but it's not enough to impact on our business. And I think it's fair to say that sellers of properties are still choosing to use local experts who understand the market, and they want somebody to hold their hand through the sales process, which is exactly what our franchisees do. Okay, so we are looking. We've diversified our revenue over the last 3 or 4 years. So, you know, we started off as a residential lettings business, then we moved into estate agency. Both areas are growing successfully. We are looking to diversify going forward. So, mortgages is the first step, really on the journey to better control the supply chain to our network of 300 offices. You know, some of the best franchise models in the UK control their supply chain, as in the goods and services sold through their branches. Prior to launching our mortgage business, we didn't control the supply chain. We're also looking to roll out block management. So if you own an apartment in a building, there's a block manager that sits above that building and looks after grounds maintenance, shared areas, collect service charges from leaseholders in these properties, and also build to rent, which is quite a large area of institutional investment. These are the large blocks going up. There are around 170,000 build to rent units either in the pipeline or completed. So we're looking to roll out block management to our franchisees, to give our franchisees in each area across these 300 branches the ability to manage small blocks in their areas. We're also looking at commercial property. So block management we're rolling out later this year. Commercial property, you know, we've got 2,000 very skilled people in our network, including franchisees and staff, managing commercial property for landlords who generally have mixed portfolios of residential and commercial. Just makes sense to our business. We've continually expanded our footprint. As I say, we now cover sort of 300, from 300 branches, we cover the vast majority of the UK. And what's happening in the sector at the moment is that the corporate estate agency chains with very heavy management structures, large expensive premises, and downward pressure on fees caused by online models such as Purple Bricks, the corporates are having a pretty tough time. Our business model hasn't faltered, continues to grow, and the key difference is that franchisee at the heart of the business, as I say, sort of working hard to grow each year. So the corporate chains are having quite a tough time. Independent agents, as in the one-man bands, which dominate our sector still, again, finding it's more difficult to operate in the sector. It's certainly more expensive. And the franchise models are performing, all of the franchise models, the listed businesses, are performing generally very well. I'm sure you've heard of Purple Bricks, you know, the sort of the most recent online agency. They're local property experts, the people on the ground who deliver valuations, viewings, the sort of face of Purple Bricks. They are local property experts. They are sole traders. They're small limited businesses. They are self-employed individuals acting as if they are franchisees under the Purple Bricks banner. The key difference between a Purple Bricks local property expert and one of our franchisees is that our franchisees are building businesses that are worth something. So if a Purple Bricks LP decides to leave and go and do something else, they have no asset to sell. An average franchisee within our network is turning over £280,000 a year on average, and the asset value, the worth of that business, is around 1 times turnover. So people are joining us, growing businesses, and then when they're ready to exit, they have an asset they can sort of resell and go. These assets can't be sold as an independent agent. They have to be sold as a franchise business. So, sort of why invest? Well, lots of reasons. I said at the beginning that we've had 22 years of unbroken profit growth. EPS has more than doubled since 2014. Across our network of franchisees, we've increased our management service fees, our royalty, by 47% in the last 4.5 years. That's not from increasing fees to franchisees. That's simply by helping them grow their businesses. Very low risk. Franchisees are flexible to vary fee models and style of business in each territory, which means that if Aberdeen isn't performing for whatever reason, the franchisee can sort of tweak the business model, tweak the fee model to increase market share in that particular territory. And of course, because we cover such a large area, if a franchisee isn't performing in Aberdeen, somebody will be performing somewhere else. You know, it's sort of a risk that's spread across a very large network. And we've got a strong strategy for future growth in terms of mortgages, commercial property, block management, very driven management team. And fundamentally, it's a really easy business model to understand. Our balance sheet is straightforward and simple. As I say, it's a profitable, dividend-paying business with significant plans for future growth. FinCap, when they put our research together for us a few weeks ago, have put a target price of £1.90 on the share. And I say we've gone up in the last week or so by around 10%. So that was quite fast, but does anybody have any questions? Far away. It's okay.
Any questions for Dorian or Louise?
With increase in your share price, do you have any intention to raise some capital to accelerate your business growth? And the other question is with in your block management situation, does the need for cladding replacement have any impact on your business at all, or are you neutral to that?
What was the second question? Sorry.
Cladding.
Just the last
when you're
part.
talking about blocks, when all these blocks have got their own cladding on now, somebody has to pay for replacing it. Does that affect you at all in any way?
Got it. Yeah, so to do the sort of 2 bits of the question. So I mean, first off, no, we're not looking to raise any money, and you might say, why on earth are you here then, Dorian? But you know, we're not looking to raise any money. We have a facility with our bank if we needed to buy, you know, a small acquisition, but no, we're not looking to. And we're simply here just to raise our profile at the present time. I think we were very conscious that we just didn't have a great deal of retail shareholders, and it's as simple as that. We're just raising profile. So at the minute, we're not looking to raise any money, but you know, at some point in the future, maybe will. We came to market in 2013 and raised 5 million, and what we used that 5 million for is. The sector is dominated by small independent agents, and a lot of independents are looking to exit the sector for regulatory reasons. A lot of independent businesses have been going for 20, 30 years. The vendors are just ready to sell and exit. Last year, we helped franchisees buy 26 of these independent businesses. So we helped franchisees bring in 6.9 million of extra turnover last year by means of buying in these businesses. And what I mean is they buy a small business with a lettings book, you know, managed portfolio. They port that book across to their existing franchise. They don't port across all of the costs, you know, some of the staff, but certainly not all of the overheads. And it's a very profitable thing for a franchisee to do. From our point of view, we get 10 or 12% royalty of that book in perpetuity. So it's massively profitable for us to do. And My point being that when we raised 5 million so that we could help fund some of these acquisitions. So we offer to lend franchisees up to 30% of the consideration across these deals. Our lending rates are quite punitive, 8.45 over base. So we're not looking to be a bank as far as the franchisees are concerned. We're just looking to facilitate and plug an equity gap. And so we've been sort of cycling that 5 million since 2013, and it's worked. You know, Louise always says that's been the hardest working 5 million we've ever sort of had. And the loan book to franchisees stands at 3.9 million. Lending terms are over 3.3 to 5 years. So the money just continuously sort of cycles within the business. So that was sort of on raising money and your first question. And then sort of no, we're not doing very much block at the minute at all. So this is going to be new to us, fairly new. We're managing 3,000 or 4,000 units, that's all in terms of block, which in the scheme of things is sort of minuscule. Block compared with residential management is very low revenue. So you need scale, you need numbers. You know, each franchisee or a franchisee, we need 1,000 units to make it profitable on the block side. So it'll be through it. So we're going to help franchisees grow organically. We don't have any exposure to any sort of high rise, particularly at the moment. Franchisees are managing small block units, sort of 6 to 8. I guess there's still a risk, you know, with anything that you're managing. And how we're rolling this out is we've partnered with a third-party provider and white-labelled a solution whereby the third-party provider will become joint agent with our franchisee, so share the responsibility and the risk, which is always good when you partner with a third party, and they'll provide compliance support, back office in terms of collecting service charges, training, etc., etc. So we sort of approach it in a very safe way. Yeah. Does that answer?
Well, we're interested in that, in the actual cladding on the outside of the building. I mean, there's hundreds of millions of pounds worth are going to have to be spent there. Yeah. Do you have to spend any of it, or does it affect your business, or are you? No.
Fortunately, no.
Good evening. Could you tell me what the turnover of franchisees is, and secondly, are the franchisees a member of, is it the Independent Franchisee Association? I don't know if that's the right term. Thank you.
Yeah, so the average turnover of a franchisee is 280,000, there or thereabouts. So network turnover isn't something that we just choose not to report on network turnover, you know, all of them together. But the maths is easy, and it's about 85 million across the franchise network. Some franchise networks report on it. It's the sort of first line within their numbers. But we just feel that, you know, that's not our business, that's franchisees' revenue. And it's sort of, you know, it's almost smoke and mirrors if you sort of report on that part. So, you know, we just report on our revenue as a business here. So not an insignificant level of turnover. In terms of memberships, we've been self-regulating for a long time. So before client money protection became mandatory, before it became a requirement for agents to offer redress via an ombudsman scheme, we had all of that in place beforehand. We've typically used a scheme called the National Approved Letting Scheme, or the Association of Residential Letting Agents. So they're two. One's a trade body and one's what isn't a trade body, but it acts like a trade body. And the main reasons that we've used both Arla and Nowles was actually to get client money protection. They're one of only 3 providers of CMP in the UK. That's now changed since April. So since April, all agents have to have CMP. It's mandatory. So a number of other providers have sprung up to offer CMP. So in a nutshell, all of our offices belong to either Nowles or Arla. Oh, so I am sorry. Yeah.
Well, actually, the turnover was really what followed.
Oh, the churn, got it. So the second part was right, but the first part not. Yeah, I mean, the churn is virtually nil. There are home-run estate agency models, and you know, a number of these home-run businesses are sort of quasi-online, you know, easy in, easy out, work from home. And And the problem with a home run style of business is that if you pay £2,000 to become an agent and you start working as an agent, if you have 2 or 3 bad months, tell me that a husband or wife at home isn't saying, get a job, get something that's going to bring us, revenue and, income in each month. And that style of network generally has a churn rate of sort of 50%. I've seen some pretty poor ones. In our network, franchisees have got an asset that's worth a significant amount to them. 280, 300,000 in terms of value, so it's not insignificant. So that they don't just close their doors and disappear. If they want to exit for any reason, we effect a resale for them. So we find a buyer, we negotiate the sort of deal for the franchise with the franchisee, and then we just replace the franchisee with somebody else who wants to come on board. Now, we tend to resell 3 or 4% of the network each year. So in H1, if memory serves, we did 6 resales in the first half. According to the British Franchise Association, around 10% of franchise networks, McDonald's, Domino's, Burson, everybody else, around sub 10% will sell each year. I think that the reason we have so few resales and so few franchisees churning is that once they've got a managed letting book of business, that revenue just keeps coming in. So they've got it. There's no reason to sell unless they're looking to retire, or go off, or they're just fed up with it. There's no driving reason for them to sell. Interestingly, our first ever franchisee was here in Scotland, Andy Campbell in Elgin, just to make our lives more difficult. We were in Lincolnshire. He was the first sort of franchisee. He's still on board, and he's now been running for 23 years. He's getting old, or older, should I say, but he's still on board, he's still growing, and he's still doing a great job for his clients in Elgin.
Great stuff. Any other questions?
Can I ask, in 10 years' time, where will this business be?
In 10 years' time? Crikey. Well, if you have a look at the FinCat note that goes forward 3 years, so 10 years, I think my personal strategy and that of the management team is that at the minute our market cap is sitting at around 41 million. That's where we are. We know that to appeal to a different level of fund managers, institutions, we need to be sort of 70, 80, 100 million. We think we can grow this business to be a 100 million market cap business, partially through organic growth and partially by doing acquisitions of a similar nature. So I'd say that really is our 3 to 5 year plan to achieve that point. 10 years down the track, how I think the sector will look in less than 10 years, but definitely in 5 years, is that there will be a new regulatory framework over anybody who's transacting in property, whereas if you wind the clock back 10 years, almost no regulation in our sector, no access to redress for clients, no mandatory client money protection. So you can see that I'm not sort of making a comparison to the mortgage market, but almost you can see it going in the same direction where people in property will need to be qualified. That pipe has nothing to do with us, by the way. It's not our exit. it's not our exit song. A very tightly regulated sector. That's coming in the next 3 to 4 years. Scotland is ahead of England in terms of regulation. Wales is now ahead of England. England's sort of lagging behind. But there was a document produced on the 18th of July called the ROPA document, the Regulation of Property Agents, and it maps out how regulation will look over the next kind of 2 to 10 years, if that helps. So I think within the next few years, we'll be viewed as true professionals. More landlords will decide to use an agent because we don't charge very much in the scheme of things. And managing a property is a serious business. And I think whichever government is in power, I think they want to see a better and safer environment for people in the rental sector. There are 13 million people renting. We're very pro-regulation. I was one of the people feeding into that working group. And I don't do that selflessly. If regulation becomes much tighter, which all parties are saying it's going to in our sector, then more people will have to use our business. It's as simple as that.